Hi friends, I am Ruben. In this video we discuss about the candlestick types. Which candlestick is best for the find the trend, is downtrend or uptrend. In this video we discuss only the general candlesticks and the bullish candlesticks. In candlestick there is a continuous pattern and trend reversal pattern. There is two patterns, continuation pattern and trend reversal. Let's see, this is a gap. Gap means this is a general candlestick pattern. The gap is an empty space you can see between two candlesticks. It is a gap between the two candlesticks. And the next one is the doji. Doji means the opening and closing prices are the same. The buyer and sellers are, there is a neutral. They are equal. And the next one is long-legged doji. Long-legged doji is a reversal candle. It is a bullish or reversal, bearish reversal. These are the criteria, the four criteria to consider the long-legged doji. The first one is the no or very small real body. The center line is a real body, it's a minimum small body. And then open and the close are very close to the middle of the candle. It's a middle of the candle, the opening and close. And then the long shadows, the line, that is a long shadow, the big, it is also big called. And then equal in length is equal. And then market can be either in a uptrend or downtrend. Then if the trend is uptrend means it is a reversal for the downtrend. It is opposite to the downtrend. And the next one is bullish engulfing pattern. The bullish engulfing pattern is a bullish reversal pattern. There is two candle pattern. The market must be in downtrend. The first candle must be red and the second candle must be green. The real body of the second candle surround the real body of the first. It is cover the first body of the first candle. The second candle cover the first candle, and then the position of the shadow on either candle does not matter. It means it does not matter, but the second candle will cover the first candle. It is big size compared to first candle. The real body will become the big size. And the next one is the bullish reversal candle of Bullish Harami. The Bullish Harami is a very famous candlestick for the bullish reversal. There is a two candle pattern. The market must be in downtrend. The first candle is red and there is a gap high between the two candles. The second candle has a very small body. The color is not important, but if it is green means it is a reversal. And the next one is hammer. Hammer is a bullish reversal candlestick. It is a most important candlestick for the bullish reversal. Hammer. There is a small real body in the top, and then real body is at the top end of the session range. And then very small or no upper shadow. The shadow is very small. The lower shadow should be at least twice the height of the real body. The color of the real body is not important. The market must be in downtrend. But most green color is the most of all reversal for the bullish reversal. And the next one is dragon doji. It is a bullish reversal pattern. And then here there is no or real body, no or very small body. And then the open and close are at very close to the top of the candle. It was top, the open and close at the top. And then no or very upper shadow in the top. There is no shadow or the small shadow. And then long lower shadow. There is a bottom, there is a long lower shadow. And the market must be in downtrend. These are the criteria for the dragon doji. And the next one is inverted hammer. Inverted hammer is a bullish reversal candlestick. It is a small real body. The real body is at the bottom of the end of the session, and then very small or no lower shadow. The upper shadow should be at least twice the height of the real body. And then the color of the real body is not important, but green is most is effective, and the market must be in downtrend. These criteria for the inverted hammer. And the next one is tweezers bottom. Tweezers bottom means there is a two candle. This is a two candle. The bottom, the shadow of the wick is equal to the post candle. Then it is a reversal for the bullish reversal. It was come in the bottom of the downtrend. That time the reversal will happen. The bullish reversal will happen. And the next one is master candle. Master candle is a very big candle. It happened. The post candle is a very big, and then there is a 5 small candles. It between that big candle, the post big candle, and then there is a another big candle. It cross the post candle, the high, the shadow of the upper shadow of the post green candle. This is called a master candle. It's very big size. And then the rising 3 method is, it means the post candle will be in very high, and then there is a small red candles. There is a 3 red candles, and then the next one is a very big candle. It is a continuation pattern. It's a composed of 5 candles, which the pattern shows 3 phases. And the next one is Marso candle. It is a very big candle. There is no wick at the bottom and top. It's a long real body and no shadows. And if the body of the candle is green, we have a bullish Marso. So, and the next one is the piercing pattern. The piercing pattern is it's a bullish reversal pattern. 2 candle pattern. It is a 2 candle pattern. The market must be in downtrend. The first candle must be red, and the second candle must be green. The market gaps lower on the open of the second candle. It means the second candle open in the lower of the first candle. There is a gap between them. The real body of the second candle must close into the body of the first candle. It is close to the first candle means there is a little difference between the first candle and second candle real body. These are all the bullish reversal candles. It come in the downtrend only. In the next video we discuss about the bearish reversal candles. If you have any doubts in this concept, please ask me in the comment section. If you like my video, please like, share and subscribe. Let's see you in the next video. Thank you friends.